So good evening, friends. Thanks for joining in with us today. And to introduce myself, I'm Pallavarajan, representing PMS Bazaar. On behalf of Avendus Capital and PMS Bazaar, I welcome you all for today's session. I take this opportunity to thank Avendus Capital for joining us for a webinar series called Decoding the Risk Return Spectrum, which we believe it is a very relevant and an important topic to be covered. And this is going to be serious. And today, whatever you're going to listen, it will be the first episode, and you'll have a couple of episodes to follow in the upcoming days, which will keep you posted. And in today's first episode, we are going to have an exciting topic, and we're going to discuss about how data science can help generate alphas and manage risk. To present this, we have Mr. Rishi Kohli, who is a managing director and a chief investment officer at Quant Strategies at Avendus Capital. To give a small brief about Rishi joined Avendus Capital recently as a part of the investment team. He has over 2 decades of experience in Indian derivatives market and has been pioneer in the Indian quant space since 2007. So today, quant space has been become more popular. We could see that a lot of traction which is happening. However, it is very difficult to see the resource who have experience since 2007. And in that niche space, we have Rishi. I think is a very relevant person to take this topic. And to give more brief about him, and in his previous role at ProAlpha Capital, he was the CEO and CIO responsible for the overall data-driven investment management and research. Prior to that, he was the head of equity derivatives at SSKI Securities, which is now IDFC, where he was responsible for largest complex option trades and quant-based trades in the Indian market. In fact, Rishi has been a speaker at many global conferences like Quant Invest in Paris, which is actually the largest global conference for the quantitative funds and investors. In addition to that, he also been a speaker at couple of quant forums at USA, Hong Kong, and so on. And Rishi has completed his engineering from IIT, and he's also MBA from IIM. I think it's a very relevant person to take up today's topic in the episode 1, how data science can help generate alphas and manage risk. Rishi, thanks for joining in, and the session is yours now.
Thank you for the introduction and kind words. Good evening, everyone. Happy to have all of you here. Let me just share the screen so that we can dive into the presentation. So yes, I'm here to talk about how data science can help generate alphas and manage risks. So to begin with, I wanted to talk about how globally there has been a massive shift from active to passive funds, which I'm sure most of you have heard about or seen the data a little bit at least. So as this shows that, let's go back 20 years, and obviously active strategies in the US, active funds had a much larger share, and passive strategies had only an 11% share. And when you fast forward to 2019, so obviously this data doesn't get, updated very frequently. So this is 2-year-old data, but it's very reflective of what's happening right now. And you see that split has become 50-50, and which is very interesting. And there's been a whole hue and cry about passive funds, AUMs increasing, which, as I was saying, all of you, I'm sure, have heard about. And this is as a result of, a lot of active strategies not necessarily performing well over time. Plus, of course, a lot more sophisticated and smart strategies coming on the passive side. And so when we talk of ETFs, for example, even in India, that would fall under passive, which I'm sure, again, many of you know about, but for those who don't. So there has been this massive shift in the last 20 years. Now, interestingly, in India, we are currently where, this US market shows end of 90 or early 2000s. Because if you look at the ETF market in India right now, that's about, 13-14%, I think, on the upper side of what the total equity mutual fund AUM is. So, and we are starting to hear more about, passive strategies and smart beta and other things, which I'll cover as I speak. And there has been more, launches from different mutual funds, etc., on some of these passive strategies. So you can be rest assured that over the next 10 to 20 years, this kind of a shift, as was seen in the US, is pretty much bound to happen in India as well. So as I was saying, that this kind of a shift can be expected to happen in India, over the next 10 to 20 years. And why have I spent a few minutes on this data is because when we talk of passive investing and ETFs, etc., it all falls under data-driven investment strategies. So while the word quantitative is obviously used interchangeably with data science, I wanted to mention about this passive stuff because the moment it becomes a passive product, it means that there is a rule-driven methodology to creating a fund or an index. And the moment there is a rule-driven methodology where no other discretionary decision is being taken, then it will end up falling under the quantitative or the data-driven investment strategies kind of grouping. And therefore, this becomes important. Further, if you look at the specific quantitative mutual fund AUM in US as well, it has grown drastically from 2010 to 17, and that has continued the last 2-3 years, in fact, at a pace of almost 19 to 20% CAGR, and is expected to continue at that pace for the next 5-10 years, which means that obviously that is again increasing as a percentage of the overall AUM. And again, in India, you have seen the initial activity in that space. We do have a few launches here and there from some of the mutual funds, some of the AIF funds, etc. But especially on the mutual fund side, if I talk about, the AUM is minuscule, 6,000 crore across 8-10 funds. So obviously there's a long way to go for the Indian industry, and that's what makes it interesting for what I'm speaking today. But many of the top houses obviously have started dabbling in the space, which also shows you how important it is to be there present in this segment. Now, going into what quantitative investing or data science, etc. means. So first, before going into this slide, like I said, quantitative data science sort of used interchangeably. So I want to get that out of the way. So it's more terminology for different sectors in some sense. Obviously, as the words imply or the phrases imply, quantitative investing again uses a lot of data, structures a lot of data, analyzes a lot of data, and then does a lot of data analysis to come to some conclusion. Similarly, data science does something very similar. It's just that the word quantitative has been used a little more in the investing world and in the finance world historically for historical reasons, whereas data science has been used a bit more in other industries, and especially with a lot of startups, hiring a lot of data scientists for a lot of analytics, etc. That word started getting used more in those sectors because the moment you deal with a lot of unstructured data, which happens in a lot of those sectors, the moment you're analyzing retail sales, credit card usage data, etc., then you end up terming it more as a data science and a job of a data scientist. So it's more, there's obviously huge overlap and more or less interchangeably possible to use terms, but just being used in different industries broadly. We like to consider it more as a data science, whatever we are doing, because we are very, very careful with the data and very focused on the statistics around it. Because the moment you are using quantitative methodologies or data science methodologies, you need to be very clear on why you are using certain data, how you are using it, is it statistically valid, how you're using the data, those kind of things. And the moment you give that a lot of importance and are very careful about it, it basically amounts to data science. Now, very interestingly, in a very simple way to explain, if you look at cricket and you look at quantitative or data-driven investing. So again, in cricket, you need discipline, whether you're a batsman, bowler, whatever your skill set is, you need that discipline and you need to keep repeating, your performance over time. You need to have some consistency. Similarly, on a data-driven investment approach, it ends up being a rule-based approach and a systematic process. And why do we do that? For the discipline. It brings a discipline, a method into the madness. There's less chances of, you're going wrong. You're at least following the methodology that you had set out as the objective. There's hardly any chance of the objective, not being targeted or a style drift coming in. So that is why that is important. Very similar to, how discipline is required in cricket or other sports. Then again, you need a right mix of players in cricket, right? You need some bowlers, some batsmen, some all-rounders. Similarly, on the data-driven investing side, you need diversification across strategy types, across time durations, across different types of techniques or methodologies that you're using. And we focus a lot on this at Avendus, for example. So it's very similar again. Again, the power play in cricket, you want to maximize returns, in investing, and you want to do it in a structured manner using quantitative or data-driven approaches. In cricket, again, when things are tough and you are not able to hit boundaries, still you take singles, you keep rotating strikes. That helps not put the pressure on you and puts the pressure on the opposition. Similarly, in quantitative investing, in data-driven investing, you keep repeating the process that you have set out. You keep taking all the trades that come up from your process. Don't worry about the outcome and the law of large numbers, which means that the longer you keep implementing the same process and the more trades that keep getting generated, it is more likely that you will land up close to your set out objective and close to your expectations. And devise a game plan, overall strategy. Obviously, there's a strategy in everything, whether it's the corporate world, sports, or investing. So here the objective is manage risk and enhance risk-adjusted returns. There are various ways of doing that, which is what I will talk of in the next few slides. A couple of important things before that is, data-driven investing. As I said, it brings discipline. A rules-based approach means that you cannot have certain cognitive biases. So as humans, we all have certain cognitive biases that are inbuilt into our human brain and human system. Some of these are mentioned here. There are obviously hundreds or at least tens of such biases, but some important ones are highlighted here, and some of these affect us in investing as well. So I'll touch upon some of them very quickly. So for example, recency bias. So I think all of us have it. If you're seeing very volatile markets, if you're seeing very trended markets, you end up saying that, okay, markets have always behaved like this. Markets are going to behave like this going forward also next 6 months. That is typically the reaction of most of us are going to have. Whereas, the opposite may be true. For example, in the end of 2007, based on how 2007 year went, if, we had thought that, okay, that is the way how markets behave, and they're going to continue to trend up, you would have been very wrong in 2008. Similarly, end of 2008 or early 2009, just before the market bottom, if you had thought that markets are going to continue like this, again, you would have been very wrong. Similarly, there have been many cases of markets being very dull and, non-volatile, non-trended. There have been patches in 2013, 2018, etc. Again, looking at a 6-month or 12-month period there, if any of us would have thought that that's how markets are going to continue, it would have been very wrong, going forward. So that's, one kind of bias, which I would call recency bias. So that is something that, again, a data-driven investment approach eliminates. Then there is confirmation bias. Typically, all of us tend to confirm our own point of view. So if I have a point of view, if I have a strong belief, you typically look for data or information that sort of confirms that belief. And typically all of us are a bit resistant to alternative ideas or data or information we get, which is against our understanding or our belief. So that is sort of a confirmation bias, and that obviously is something that is not good, because it is good to take all types of data into account before coming to a decision. Similarly, there's an anchoring effect. There's a herding bias. Obviously, I'm sure a lot of you have heard about it. We all tend to herd. That herding mentality is what creates momentum in the market. And that is something that we do focus on at Avendus also. And a lot of globally data-driven funds focus on. That is inefficiency in the market comes about because of herding bias that we all have. But again, a data-driven approach can take advantage of it, as well as not get affected by it. And then survivorship bias is very important. For example, especially when you are doing your backtesting or simulation in a data-driven investment approach, then let's say you are looking at index constituents, right? How they are changing over time. If you're looking at the index constituents today and designing a strategy based on how you would have selected or not selected stocks from that index, those constituents may not have been in the index 5 years back, for example. So you're testing it only on the stocks that are there in the index right now is not the correct way to be simulating or backtesting or using a data-driven approach on an investment hypothesis that you have. But a lot of people, especially beginners and younger people in the industry using quant or data-driven approaches, would end up doing that. So those are things that one needs to be very careful about. And when you're following a data-driven investment approach. Then various types of such strategies, again, they fall in many buckets, but some of the main larger buckets I've mentioned here. So long funds, again, smart beta is a term, we've started hearing in India. I'll touch upon, what it largely means in a minute. Factor investing, quantamental, market neutral funds, you have statistical arbitrage, volatility arbitrage, long short funds, you have equity long short, you have managed futures. We are also doing some work in some of these areas, which I'll touch upon in a couple of minutes. Largely what ends up happening is if I just differentiate between these categories, then long funds obviously means that, you're similar to long equities, any equity mutual fund, etc. But when you are looking at factor investing, then you have quality factor, you have growth factor, you have value factors, and there are some ETFs and some funds now in the Indian markets which focus on some of these. So you're looking at these different factors and creating portfolios, based on what those fundamental metrics sort of highlight. And then smart beta is something like, the issue with market cap weighted indices. So instead of weighting just because of market cap, you use different weighting methodologies. Maybe you use the same stocks, maybe you eliminate some stocks but you use a large part of the same stocks in an index, but you use different weighting methodologies based on different metrics. It could be as simple as equal weight. It could have different weighting methodology based on fundamentals or price based or volatility, etc. That would largely fall under the smart beta category. Quantamental is something, again, some funds in India have also tried, where it is a mix of quantitative and a fundamental fund manager, sort of a mix of things. I wouldn't call it fully quantitative or fully data driven because there is that element of discretion there, but it would fall into the category of long funds using quantitative or data driven techniques. Then market neutral funds, meaning that you're not taking any exposures to the market. Your net exposures to the market are completely zero. So there are a couple of ways. Obviously, a simplest example is, cash futures arbitrage because there is no exposure to the market, but that is absolutely zero risk. Whereas some of the others like statistical arbitrage, volatility arbitrage, equity market neutral, these have zero net exposures, but obviously do have some volatility, some small 2, 3, 4, 5%, losses or drawdowns that come up. But the goal is that not be agnostic of market direction and still try to extract returns from the market. And long short funds are ones which have some long exposures, some short exposures, are not zero net exposures, have some net exposures, whether it's low or high, but can go from net long, net short, low net exposure, high net exposure. So they can vary their net exposures quite a lot. All of those types of funds would fall under long short. Now, again, I mentioned about the AUMs of passive and US quant mutual funds. Here, there is another bifurcation between smart beta quant mutual funds and factor-based mutual funds. Again, in the US, and you see how that overall pie has grown and how some of the different segments have also grown a lot. Again, it has that 17 to 20% kind of growth rate depending on the segment you're looking at. So again, something similar, could be expected to happen in India over the next 10, 20 years, which is why what we are discussing today becomes important. Now, long funds, obviously, we all understand a bit more. So the market neutral side and the long short side, I would touch upon a few of the strategies a bit more. Like I mentioned earlier, equity market neutral funds, agnostic of market direction. It is an active strategy. You could have various ways of defining your market neutral portfolios. So when you have zero net exposures means you may have some stocks you are long on, some stocks you are short on, and your net exposures to the market are zero. But which stocks you want to go long, which stocks you want to go short, you could choose them based on either fundamental parameters or statistical parameters or price-based or technical parameters. That can vary. And then, statistical arbitrage is a very particular, like pair trades, which I'm sure some of you would have heard. That is a very narrow example of what you can do in equity market neutral. But for example, some of the things we do at Avendus also are things like, let's say, based on different factors on the fundamental side, we will, from a BSE 100 index, for example, we will pick up 10 stocks to long and 10 stocks to short based on certain fundamental factors. Then again, based on certain price momentum factors, we could pick 10 stocks to long and 10 stocks to short, either out of Nifty 50 or out of BSE 100. So those are different ways of, creating market neutral models or portfolios. And obviously, there are advantages, disadvantages of every strategy. So here, typically, you will end up having low risk to the market, stable returns majority of the time, and low correlations because you're agnostic to market direction. So whether markets rise or fall, you will typically be making some absolute returns. So you have lower correlation to the broader markets. There could be higher churn. Something like statistical arbitrage would have even higher churn. Some of the portfolio-based long short I mentioned, that has slightly lower churn, but still relatively higher churn compared to long-only funds or things that would rebalance on a quarterly or an annual time frame. Because here you are typically rebalancing on a weekly or a fortnightly or a monthly time frame at max. This is just quickly showing you how the AUMs globally have moved in equity market neutral strategies. So obviously there was a huge up move after 2009, 10, 11 because some of those periods showed the efficacy of these strategies. Last few years it's come up a little bit more to do with different kind of market environment and typical ebb and flow of the AUMs, but it still remains at a reasonably high level, much more than 10, 15 years back. And that gives some insight into how things can grow in India also on such strategies going forward. This is an interesting chart which shows you intra-sector dispersion even in India. So even in India, different sectors, short forms for different sectors have been used, which is less important. This is just to show, how in the last 4-5 years, different sectors, you've had the max and min returns of different stocks in different sectors being very different, and the mean median returns being very different, which means that even within a sector, there is an opportunity to be long some stocks, short some stocks, and make money. So that's how, a market neutral strategy, let's say it's sector neutral, it could go long some stocks, short some stocks, and make money. Or it could be intra-sectors, it could go long some sectors, short some sectors, and still make money because different sectors are giving you different returns in different years. So this is just to give you a quick snapshot of that, because that means that both market neutral and long short strategies can take advantage of these kind of dispersions to make money. Coming to equity long short, again, an active strategy, but like I said earlier, it keeps some net exposures. It's not zero. In India, we have seen some long short funds, including a fund from Avendus, where the low net exposures are being kept. Globally, you could have funds which are more long biased or having higher net exposures, or dynamically changing net exposures from higher 70, 80, 90% to low 10, 20%, depending on the markets. So obviously there has been a little bit of difference on how long short has been defined globally and locally, but it could be a mix of those things or diversified across those things. Again, the advantage being low correlations to many other strategies, typically attractive risk-adjusted returns. If you have low net exposures, there is lower risk and therefore, and still consistent returns. So you have good risk-adjusted returns. But if you have slightly more aggressive moves in net exposures and you do go to higher net exposures at times in long short funds, then you would be targeting equity-like or more than equity-like returns, and but with lower or volatility and drawdowns, and therefore targeting higher risk-reward ratios. So whatever the objective and whatever the comparison, basically you're trying to target higher risk-reward ratios with lower correlations. And that is a basic theme of whenever you try to use data-driven strategies. that is what you try to achieve, that, okay, which is the bucket that I'm targeting? And in that bucket, can I have more attractive risk-adjusted returns? Can I have lower correlations to everything else I'm being compared to? Because the moment you have lower correlations, you become a very attractive fit in any portfolio. So as a lot of you would know, that if you have low correlations to other strategies, which a lot of these long short and market neutral strategies would have, then you are more on the efficient frontier when you are combining it with your typical equity and debt allocations. So those are the advantages at a broader level as well. Again, another simple example, this is just showing you a 30-day rolling correlation of the stocks. Let's say Nifty 50, this is about on the stocks in the Nifty 50 and their correlations between each of them and Nifty. And it is showing you how the correlations go from low levels to high levels, which is also showing you that there is a lot of opportunity for relative performance. And that is where long short strategies and market neutral strategies come in, right? So when you have high rolling correlations, means all stocks are behaving similarly, then probably the opportunity to make money through these kind of strategies is a little lower. But when you have low correlations, then it means different subset of stocks are doing differently, and therefore your opportunity to make money is very high. So these are various ways in which you can keep track of the environment that you are in and whether that is conducive to such strategies or not, which is what we use as well. Another type of long short strategy is what is now globally called managed futures. Earlier it used to be called CTA. And this is something also we are using actively at Avendus, which I'll come to in a minute also after explaining this at a broader level. Here it is an active strategy. It is more directional. It is typically momentum focused or trend following focused. You are going long the markets, you're going short the markets also with aggressive directional exposures. And the idea is to capture either short-term momentum or trends or long-term momentum or trends. And the interesting thing is that this provides a very attractive portfolio diversification. Globally, of course, it's used across a lot of countries, a lot of geographies, across a lot of asset classes. So, you get exposure to a lot of them and therefore a lot of extra diversification. In India, for various reasons, it is largely the equity markets where, we are able to use this effectively right now. But even then, it offers a lot of diversification because you can go aggressively net short the markets as well. And that would obviously help in periods like, let's say last year, March 2020, or before that in any large up month or down month. These could be very attractive. There are some examples, some names which are not very typical, and therefore I've put them there, which could be interesting for you all to see later, because the typical conversation in India I've seen is that, okay, are these strategies scalable? Are these strategies widely used? Are there large funds in this space? So yes, there are funds which are 5 billion, 10 billion, 20, 30 billion dollars also in this space and very successful. So these are very scalable strategies. The beauty is that these have low to negative correlation to most other strategies. So even when we are doing this on the equity markets in India, we have zero correlations to the Nifty, for example. So that is the interesting thing. And by definition, when large market crashes happen, then typically these strategies do very well. So globally, there is a term called crisis alpha that got formed because a lot of pension funds, did analysis after 2008, and they realized that this group of strategies is the only ones which in the last 20, 30 years has always done well when markets have fallen. So whether, in the US, obviously, because these strategies have been around for 30 years. So they saw that, okay, 92 bond market crisis, 97 Asian currency crisis, LTCM debacle, 1998, Russian default, 2001 dot-com crash, 2008 credit crisis. So across all these crisis periods where almost all other strategies did poorly, this was the only group of strategies which has always done well. And therefore, there was this terminology got created called crisis alpha. And that is something that we've seen effectively in India as well. And that is a big advantage this strategy has. Disadvantage is that this can have longer periods of drawdown as well. It may be smaller drawdown, but the duration of drawdown sometimes is very draining on the portfolio manager as well as the investors. And because it is non-correlated, it is always not easy to understand why the drawdown is happening. And then, of course, you're going long, you're going short, both sides directionally, which means now that you have chances of getting whipsawed on both sides instead of only one side for a long only fund, for example. So those are the disadvantages. Here you see the huge growth in AUM in managed futures, and you see this post 4, 5, 6, and especially after 2008, there was a huge bump up for the next 4, 5 years. And that was driven by the pension funds globally on the realization that I talked of earlier. And it shows that very smart money and very stable, sophisticated money, which are the pension funds and sovereigns globally, went into these strategies, which is very interesting for all of us to know. This is what I was mentioning earlier, that in fact, this is research done by CME and many other bodies globally, that your typical equity bond allocation, when you add managed futures into the mix, then you are much more better on the efficient frontier, which is what this graph is trying to show, that instead of a 50 bonds, 50 stock allocation, which is been talked of globally for a very long time, the moment you have a 40, 40, 20 with 20% managed futures, then you end up being much, much better in the longer run. And the reason is the non-correlation of managed futures over longer periods of time to both equity and bonds, and its advantage of making money when markets fall. Periods like March 20, August 11, October 08, as I was mentioning earlier. So which is why also the combination of equities and managed futures, even those two things can become very, very interesting. And to give you a more practical example of that, for a couple of slides, I would also talk about, how we are trying to use that. So in fact, in our Avendus Enhanced Return Fund, we are trying to do that. We are combining long equities with managed futures, where, we have a long equity allocation of 80-85%. And with the remaining money, we are able to go from 100% long to 100% short on a mix of Nifty and Bank Nifty index futures. And the mix of that ends up, as this summary shows, a lower drawdown than the markets and much higher returns, and while being, positive across a lot of time periods, or being very low losses in periods when markets have fallen. So that is how effective combining equities and managed futures can be, and what we have started doing at Avendus as well. Of course, it comes from the experience the Avendus team, who has been there for many years, has had, and from my team's experience on the quant side for a very long time, since 2007, when I've been on the buy side, and from 2011, 10-11 onwards, when I and the team started managing strategies on a live basis. We've had a long experience on managed future strategies and a lot of data-driven strategies. And that is how this strategy came up, that combining these things is very effective. And there is a lot of such data which is very robust globally on why these things should work well together, which I just touched upon on the data from CME that I showed. Very quickly, the same thing, top 10 worst 10 months on the Nifty, how the Nifty plus the long short managed future strategy can do. So as you see on the upside, you end up getting similar or better returns also in the best months, whereas in the worst months, your losses are either much lower, or in some months you are even making positive returns. So that is how, some magic can be created by combining non-correlated strategies. And that is where correlation is very important for data-driven strategies. Now, having said that, I'll spend a few minutes before opening the floor to questions, is, issues with data-driven approaches. Issues meaning, these are not issues in the sense that you cannot solve for them, but things that one needs to be very careful about while following a data-driven approach. And some of this can help some of you, when you're analyzing quant funds or data-driven funds, because since this is relatively new to the Indian industry, we always are not very sure on how we can analyze these kind of strategies, how we can compare these kind of strategies, what could be the issues around these strategies. So there are a couple of typical things that come up, and it is common locally, globally, and between all types of investors, all types of fund managers, etc. And therefore very important to explain. So most important is what I mentioned initially, GIGO, right? Which a terminology we all know, garbage in, garbage out. So since data-driven strategies focus on, analyzing data and using that to create strategies. So finally, the data is very important. So cleaning the data, ensuring its correctness, ensuring what I mentioned earlier as some of the confirmation bias, survivorship bias. So all of that needs to be accounted for. And if your data is not clean, if you've not solved for survivorship bias issues, meaning that the example I spoke of earlier, that when you are selecting stocks from the index based on a certain methodology, which is quantitative or data driven, then you have to also ensure that over time you are choosing the right index constituents and selecting stocks from there based on your methodology. You're not only doing the back test or the simulation based on the stocks that are there in the index right now. So those kind of issues become very important. Cleaning the data becomes very important. So if all that is not done, then the output you will get is obviously useless. Then the biases I already spoke about. Solving for them, there are ways to do it. I explained how the right index constituents can be used at different points in time. There is a problem in quant world of curve fitting, overfitting. So, and again, some of you may have had experiences on this on a live basis, where typically your live returns end up being, or live performance ends up being much poorer than what you were expecting based on what you've seen in the backtest or simulation. Now, why does that happen? The first is what the investment manager or the fund manager can solve for, and it is important for him to do it, but which a lot of people don't, is that you have to have the right process for ensuring that curve fitting or overfitting has not happened. So there is a certain way you need to have an in-sample, out-sample method, which means that you need to first test your hypothesis, do whatever optimization you need to on a certain part of the data. Let's say I tested it on 2000 to 2010 and created my rules. And then I run it from 2010 onwards on a rolling 1 year, 2 year basis to see how the results are, rather than just taking the entire last 20 years and deciding what my rules or my optimization should be. Because in the latter case, it will end up being a curve fitting case. You'll end up picking the best strategy for the last 20 years. But when you do it on the first 10, 15 years and then rolling it forward for 1 year, 2 years, then you are sort of using the blind data and using rules from earlier, seeing how it is working on data that the rules have not worked on earlier. And therefore, after that, if you get certain results, then they are more likely to be robust. That is one thing. The other is, despite doing all of that, you can be 90 to 95% avoiding curve fitting, but there is that small percentage probability that remains that, some spurious correlation, some issues have come into your data-driven methodology. So that is something that you basically cannot do anything about. But whenever you do your backtest, you sort of scale your expectations down by 5 to 10%. That is something we should all do to be a little more realistic. Then very important is the frequency at which models get updated. So again, I've heard a lot of people locally talking about, are things changing every day? Do you take inputs every day or every week and change or update your models? Now that is actually not the correct way to do it, because statistics says that, there is a certain frequency at which you should be updating certain models. So yes, if you have high frequency models, which are doing thousands of trades in a day, then maybe updating it every few days or taking a deep dive every few days and taking the output from that and then doing some updations is okay. But the moment it is not high frequency, the moment it is at least a couple of days of holding period. So for example, a lot of our strategies have a average 1 week, 2 week holding periods. Then updating it every day or every week is not the right approach, because statistics says that there are a certain 100 data points, 200 data points that you need to have before coming to any conclusion. And therefore, unless you have those kind of data points, any analysis you do is not statistically correct and is meaningless. But a lot of people fall prey to this. It just seems very exciting and very sophisticated to be keeping updating things at a much shorter time frame, but that is not correct. Then adjusting for trading cost slippages is very important. Again, this is more important for more high churn strategies and less important for things that do not churn that highly, because a lot of times good quant strategies or data-driven strategies, they will show you attractive returns on a standalone basis. But the moment you take slippages and trading costs into account, then those returns completely erode. So one simple example is, if you just trade overnight every day on the Nifty and intraday you're out, so you're buying every day in the close and exiting every morning, then actually all the returns in the Nifty over the last 20 years has come via that. Whereas if you buy in the open and sell in the close, then you actually have negative returns over time. So why do we always have to be invested in? Why do we, not just do something as simple as this? The answer is that the moment you put the trading costs and slippages into account, then those returns vanish. So therefore, even correctly interpreting such things, taking the right impact cost slippages into account when you're modeling makes a big impact into how your real world results will be compared to your backtest or simulation. And the other is, of course, having a lot of global experience, tells you about a lot of different challenges that you can face. Because like I mentioned earlier, that these things are very new for the Indian market, but globally they've been around for a very long time. So there are a lot of learnings globally that we can take from. And of course, for me and my team, that has come in automatically because we've been doing this for the last 13, 14 years. And in fact, I, for example, managed an Asia fund where we were trading all the Asian equity index futures, Nikkei, Kospi, TAIEX, Hang Seng, etc. And therefore, a lot of the learnings from the global markets and even using some of the global data so that we avoid overfitting, curve fitting issues, all those are techniques that we have learned over time. And therefore, we are able to implement more actively. And I think that is obviously a big positive. And, being able to do your simulations on, if they are robust models, then they should work on many more indices or many more instruments, not be only working on, the Indian market or the one or two instruments you have chosen. That is also very important to avoid a lot of issues or challenges that can come up through such methodologies. And then you should always have some statistical ways of estimating model breakdown, right? So your methodology or model can have periods when it is not working, which could be a part of the normal cycle of a strategy. So every strategy will have its periods of strong performance and a little bit of underperformance. That shouldn't worry you as long as that is in line with the objective that you have. It is in line with the expectations that you have based on the data analysis you've done. But the moment it is not, then there have to be statistical ways of estimating that has the model broken down, has it lost its efficacy over time. And you cannot do that at your whims and fancies. There are clearly defined statistical ways of estimating that, which we take a lot of care about, for example, in whatever we do, and that has to be done correctly. So doing any of these things incorrectly, can lead to a lot of issues where you may be thinking you are doing a lot of data-driven analysis, but you're actually doing it incorrectly and therefore be having problems. So we at Avendus obviously take a lot of care in each of these things and use it very, very effectively. So with that, I mean, that's largely the key points I wanted to touch upon. Would be very happy to answer specific questions.
Rishi, thank you very much. Indeed, it was an interesting presentation. And in fact, you have shared your wisdom on how data science can help generate alphas and manage risks. In fact, it was very fascinating to see the comparison study and analogy on the cricket. And one good thing about the presentation, what I loved is that in each of the strategies, you've been trying to explain the pros and cons, and you've been trying to explain the advantages and disadvantages of each strategies. And in your last slide, on the quant strategies, broadly, you also spoken about the challenges about the quant strategies. Also, the good thing is that you also given a solution from your perspective. So it was a very interesting session. So we'll move on to a Q&A session. See, I have collected a few questions from our end, from our client side, and we'll also take few questions from the client end. We'll broadly try to have 15 to 20 minutes of Q&A session. And if there is any question which is unanswered, I will send across these questions to you. Rishi would request you to revert back so that I send it to the relevant client whoever raised the question. So we'll move on to the first question. Let me take the first question from the forum itself. Is data science-based investing is similar to smart beta investing?
Yes. So as I was mentioning, touching upon in the initial part of the presentation, so data science becomes a much broader term. Like I said, quantitative investing, data science based investing, those are interchangeably used terms. Smart beta is one type of strategy. So as I broken down long only, market neutral, and long short funds, and within long only, smart beta was one type of strategy. So you could say there are I mentioned the large three categories in data science driven investing. Within that, long only is one piece, and within that, smart beta is one category. So it is a subcategory in some sense.
Okay. See, now the next question is from Puneet Agarwal, and you just wanted to understand with this quant strategy, what are all the product which is available? I believe only AIF is available, right? With the vendors.
So yes, AIF is there. I mean, we do have a PMS which is long short, but it's obviously not quantitative. It is fundamental long short. But currently, yes, AIFs are the ones, because as you all know, that only in AIF can you have gross exposures go above 100%. So to do more interesting things using these market neutral or long short strategies, your gross exposure, even if your net exposures don't go above 100, your gross exposures do go above 100 sometimes. And therefore, AIF funds are the ones that we would focus on.
Okay. The next interesting question is from Subramaniam. I think it should be a challenging question for you. How much alpha is predicted in this process?
So see, alpha again depends on the type of strategy. Again, it will vary a lot. So when you're talking of market neutral, you're really talking of absolute return. You're saying markets go up, down, sideways, doesn't matter. I still want my 12, 15, 18%, whatever your target may be. And again, that target may vary depending on the type of market neutral strategy you're following. Whereas in a long short kind of strategy, where I was giving the example of our enhanced return fund, where we're combining equities and managed futures, there obviously our benchmarking will be a little more to the index. And we'll say that, okay, over time, we want to outperform the index post taxes by 3 to 5% annualized alpha. So again, based on different types of strategies and different objectives, that will vary. But yeah, for more details on what we are focusing on, I can obviously discuss this more offline.
Okay. So this is very important question. Can you tell us about the Quant 2007? Remember? In fact, I want to ask this question someone who have been there in the market in 2007 and was doing this quant strategy. Okay. And I was finding very difficult to find in this category. So luckily I have you. So where suddenly a lot of quant fund in 2007 we saw huge losses in matter of days. Yes. And then equally there was a sharp recovery. So what step one can take, or what you have taken to avoid such scenarios in future?
So that's a very good and very important question. Actually, I'm glad you asked this. So what has happened in 2007? So this was specifically in August 2007. And what has happened is that some of the best names globally, Goldman Sachs, Barclays, etc., some of the best names in the world and on the quantitative or data science side were involved here, and they all had losses at the same time. The fundamental reason was that, a lot of them were doing very similar strategies. So they were more on the fundamental factor-based long short side, and they were using similar factors or similar metrics, you could say, to choose the longs and the shorts from very similar indices. So they were sort of what I call overcrowding in a certain type of strategy. So what can be done to avoid that is in fact something that I am very focused on, personally, and as our team, we are very focused on for the last 10, 12 years, is that we have strategy diversification and time duration diversification. So we don't want to have all our eggs in one basket from a strategy perspective. Even if I have the best, model, I would still go with 5 or 6 models. And I would see that each of the models are focused on different time frames. Some may be focused on a few days holding period, some on a few weeks, some on 1 or 2 months as well. So what will end up happening is that even if a lot of people are suddenly somehow trading in a certain time frame, my other time frame strategies and my other strategies which are not related to that will run very smoothly. So I will have a problem in 5 or 10% part of the portfolio, not in everything else. So that time diversification, strategy diversification I was talking of, that becomes very important.
Interesting, Rishi. So ideally strategy diversification and time diversification would be the right strategy. Great. Thanks. Okay. Thanks for that. So broadly, most of the questions, whichever I received or even in the forum, many of them would like to understand what is the ideal time frame of data one should look at while analyzing the underlying model or analyzing the performance of fund. People talk about 3 years, 5 years, 10 years. So what would be the opt time, to do analysis?
So again, great question. And obviously, this is most important, I think, because when we are talking of analyzing data and coming to a decision, that is the starting point. I was talking of ego and using the right data, etc. So I'm glad this was asked. So data, the more the data, the better, obviously, because the longer time period I get, the longer you can analyze different time periods. You can see what could be issues with different types of strategies. So like we discussed, 2007 was difficult for certain type of strategies. 2008 managed futures did well, but for a lot of equity market neutral quant strategies, it was a tough period. 2012, 13, 11, 12, 13 was not good for managed futures. So different types of quant strategies will have problems in different types of time periods and different types of market conditions. And therefore, having very long and large data sets is very important. And therefore, the longer the period that you can get, the better. Now, in India, obviously, let's say if I want futures data, right, on the Nifty futures, for example, I don't have data more than 21 years. And let's say I take the Nifty index also. Even then, I have data for another 5 or 6 years. Beyond that, I don't have data. Whereas if I go to the US, I can have data even for 100 years, right? So to that extent, it limits me in India. But having said that, in India also, you take as much data as possible so that you also see, different time periods and different market conditions. I've seen a lot of people only looking at last 5 or 10 years, saying that markets got more liquid in last 10 years. We have more clean data in last 10 years. So that is fine. But then you are missing out on a lot of different market conditions that happened before that. And therefore, it may amount to a certain type of curve fitting. So that is not the correct methodology. Again, the other way of solving it is, like I said, test it on global indices. So if you have a robust model, it may not necessarily work in the US, but it may work on other markets which have similar volatility characteristics to India. So at least test it on those. Test it on other emerging market indices. And it should give you similar results if it is a robust model. And that though, if those have longer data, then use that. So data, meaning longer data, better data is always good.
Wonderful. So in the interest of, again, participants, give us some 3-4 important points one needs to consider while analyzing the quant fund and for the fund allocation as well.
Yeah, sure. So one is, as I said, the objective and the theme. So one thing is, obviously, compared to a discretionary fund, a quant or a data-driven fund ideally should not see any style drift. By that, what I mean is, obviously, let's say you're a fundamental discretionary manager and you say that I look at growth factors more, I give that more importance. I don't give that much importance to value. But if I go and look at your portfolio, maybe you have more value stocks, right? And maybe not always, but maybe at certain turning points in the cycle, I have seen a lot of the best fund managers also falling prey to, this problem. So when I follow a data-driven approach and I say that, okay, I want to only track growth parameters and build portfolios on that, ideally, I will not have this problem. And therefore, style drift problems should not arise. But it is again something to keep note of as a red flag. Because if in a data-driven approach also, that style drift is happening, then that is the biggest red flag to me. I mean, that means that probably someone is not following the process efficiently. And if that is not being followed with discipline, then it is, taking away the entire importance of following a data-driven discipline approach. So that is most important. The other is hidden risk, right? So again, it amounts to the time period. Now, unfortunately, in India, we don't have funds or with a longer track record right now. But, looking at last 2 years or 3 years or 5 years is a very short duration. And ideally, there are tail risks for a strategy that can come in some different market condition. So, and we've all seen it in different ways, even in the Indian markets, right? Not in the funds necessarily, but let's say a lot of option strategies, right? Which sell options and make money. So we've all heard of episodes, even in Indian markets, where in various prop desks or various places, you've had 2004, 2006, 2008, even last year, 2020, where for 5 years or 10 years, strategies will show very consistent returns. But then that 1 in 5 year or 1 in 10 year event will come where the strategy will just blow out and become completely bankrupt or lose, you have a huge drawdown. So those issues are there. So therefore, going behind the strategy, just the returns, and trying to understand, having some attribution to what kind of market conditions or what kind of factors it can relate to both the returns and the drawdowns, and then seeing if in those market conditions, the strategy does accordingly good or bad, is very important. So for example, in our managed future strategy, I have been for 10, 12 years been showing the same page, that these are our best market conditions, these are our worst market conditions. If Nifty moves like this, I should have a good month. If Nifty moves like this, I should have a bad month, right? And 95% of the times, you can just look at that chart and know what my performance would be for the month.
Correct.
So, and even when I'm doing well, right? So in a period where I'm supposed to do badly, if I'm doing well, then you should question me. So those kind of things are important when analyzing things.
Thank you. It was indeed an important points, and you also given some red flags, which will definitely cautious the participant, whoever is interested in the quant side. More to the next question. See, even ETF to an extent, I believe it is a quant, and now there are some quant mutual funds, and also you've been talking about your quant, how your approach on the AA fund. So if you can give us a difference between ETFs and this quant mutual funds and quant AA funds, would be very insightful for us.
Sure. Thanks. So ETFs, obviously they are more passive, more single factor oriented sort of thing. So we have ETFs which are just tracking indices as well, right? You have the Nifty and the Bank Nifty and various indices ETF. So those are just tracking the ETF, the underlying indices on a passive basis. When the moment you move from an ETF to a quant mutual fund, it means that the mutual fund on the quantitative side can be mixing many different factors or be using many different methodologies of their own, not necessarily be just tracking indices. So it becomes a little more of a blend of a passive and an active approach, where the active approach is not the fund manager making discretionary decisions, but it is more a function of the fund manager using different types of methodologies, or maybe even combining different factors, right? Even factor-based ETFs will typically take one or two factors, right? You may have a growth ETF, you may have a low volatility ETF, which we have now in the Indian markets, right? Things like that. But on a quant mutual fund side, a mutual fund manager can combine. He can have a 3-factor, 4-factor combination ETF, combination mutual fund, or he can have a very different methodology of creating a portfolio and have that as a mutual fund on the quantitative side. Then we come to the AIF side, what we are focusing on right now. There, as I said, obviously you have a little more flexibility that you can vary your net exposures. You don't need to be long. The first two categories will by definition have to be long only. Here you can be more long short. Either you can have low net exposures, be more market neutral, or the fund we already have where we are combining equities and managed futures, where we go more directional, go more long, more short, and try to make money. So those flexibility will come in only in the AIF because of being able to go up to a gross exposure of 200%. So those are the key differentiations, because the strategy starts varying, the objective starts varying, and therefore the way you can use it as a part of the rest of your portfolio of equity bond funds, will vary on which fund you select. Therefore, that is most important. Cost and all that will also vary depending on these different structures, because the more sophisticated you try to make it, obviously the cost will increase a little bit, but then the alpha you're expecting will obviously should increase a lot more to justify that.
So thanks, Rishi. Thanks for differentiating each product. I'll take one last question, due to the time constraint.
Sure.
So you also have a global exposure, and you also have more than 2 decades of experience, and in fact, more experience in the quant side. So any major global or a personal learning you want to highlight as a single biggest contributor to success and failure of a strategies or a fund?
Yes, surely a couple of points I would like to highlight, some learnings and then some sort of takeaways for everybody, so that they know what the practical expectation should be. So from global learnings, a couple of points that I highlighted earlier, but I would like to summarize. One is that obviously the longer the data, the more global the experience or background or simulations one does, that is always better. Secondly, simpler is better than complex. So while analyzing data, different tools we use, different terminologies we use may sound complex, but just as I've tried to, simplify it today and explain it in a very simple, practical manner, similarly, trying to be able to do that even as a data-driven fund manager or a quantitative fund manager is very important for me. So, while we have machine learning techniques and other things, I feel that you should be able to, as a quant fund manager, relate it to some very commonsensical standard market principles, and only then take the rule or the data as important. If you cannot, and if it is just, coming out from the data and you cannot explain what the strategy is, then I would again take it a little skeptically and not just use it always. So those are a couple of things which, one should take care of. And therefore the simplicity part comes in, because if my data analysis and my commonsensical understanding is matching, then I have more confidence on the data rather than just going by it blindly. And broader takeaways for everyone is that, see, the moment we say quantitative or data-driven approaches, what I've seen is that there's this human tendency that, suddenly you become God. You cannot have any bad patches in performance, or everything should go right. That should not be the case for anyone to think, because there's no perfect strategy out there. Every strategy will go through periods of outperformance, underperformance, but whatever objective is outlined, whatever time period frequency is outlined, over that time period, definitely a data-driven approach should be a little more repetitive in nature, should be able to show that efficacy again and again over a rolling 1 year, 2 year period, whatever the objective is. But within that period, the ups and downs will come. And just like, for any discretionary fund manager, there are good, bad patches, which, we take in our stride. But the moment we say data, we expect some perfectionism, which is never there. And finally, there is no golden strategy that will always do well. So, you have to take that with a pinch of salt and be practical about it.
Yeah, Rishi, thank you very much. Indeed, it was a very interesting presentation, and thanks for your patience, and thanks for addressing, almost all the questions.
Thanks a lot.
And
it was good talking.
Same here, and participant, hope you enjoyed the session and look forward in hosting another such event. Thank you, everyone. Thank you.